Very good afternoon. You're watching the newsroom right here on ETNow. I am Ajaya Sharma. The markets are trading at day's high. Good amount of recovery seen in IT stocks. Banks are not selling off the same way they were yesterday. And guess what? Cement stocks are powering ahead. Grasim, Ultratech, ACC, all of them are gaining. In fact, if you just look at it closely, last hour of trade yesterday, bulk of the fall came in by 4 or 5 stocks. The advance decline was pretty okay. I was looking at the data point last 10-15 days as well. 75% of the days in the last 2 weeks, advance decline was favoring the advances, which clearly meant the fall was mainly led by a bunch of large cap stocks. The remaining of the large on the wide market, which is mid cap, small caps, were performing very well, and that is getting reflected in today's market as well, trading at day's high. Arun Malhotra of CapGrow Capital is also joining us. Arun, afternoon. Thanks for joining us on ETNow. This incremental news yesterday that there's perhaps a fresh invasion by Russia on other parts of Ukraine may have, kind of made the market nervous just a bit. But historically, we have seen that the same kind of news doesn't impact the market in the same way. Has the market completely overcome the issue of war now? Perhaps some other new worries market will find going forward, but at least for now, war is in the price.
I think if you ask us, our belief is there are a lot of macro concerns which are hovering around the market. One is definitely the Russian-Ukraine crisis that has led to a lot of disruptions, both on the supply and the demand side. The second is the inflationary pressure that is because of the higher oil prices and the commodities across the globe. How would these two, and the rising interest rates, we have already seen US inflation is close to 8%, historic high in last 40, 50 years. Even in India, we have started seeing some prices inching up. I think these concerns are the biggest risk to the markets. Maybe one risk playing on the market on a particular day, but these risks will haunt the markets in the next 6 to 9 months unless we see some stability in prices. Inflation is the biggest risk to the markets right now.
So let's talk about that point of inflation a little more. Yesterday, the way IMF cut the growth forecast for India and rest of the world quite sharply, they are not alone. Many other agencies have done the same. If indeed the world is slowing down in a major fashion, look at the European parts of GDP. China was very low. 12 months far out, if the growth will be lower than what it is today, can commodity prices remain higher than what they are today?
That's our belief. They will not remain. There will be a pressure. We have already seen pressure on commodity prices. A lot of these price rises are supply-led disruptions because of the supply, not because of the aggregate demand. We are already seeing some easing of the demand. So we believe these commodity prices will come down maybe 6 months, 9 months down the line.
Let's talk about how are you analyzing the valuations of various parts of the market right now? Given the fact that the numbers have been scaled back once again this time.
I also wanted to touch upon the IMF point which you mentioned.
Sure.
Mind you, despite IMF lowering the growth rate to 8.2, India continues to be the fastest growing economy in the world. So the inflow will come in, the FIIs will return back to the markets. This is what our strong belief is. And we have seen this time and again in the past. It's just, maybe a momentum sort of investors who are probably looking at 3 to 6 months. But over 9 months, 12 months, 15, 18, 3 years, 5 years, India continues to be the best emerging markets in the global trade. Now your question on, how will we face next 12 months? I think the returns would be back-ended if you ask me. Probably next 6 months, little challenging because of the concerns which I raised. But returns, a lot of structural changes have happened in the Indian markets. Government is pushing its thrust on the infrastructure. So we will see these government schemes, these PLIs, the focus on manufacturing, yielding results in the next 12 months.
How have you designed your portfolio in this kind of a market? Did you also take advantage of the fall in the last few weeks and months?
Yes, but I think HDFC is our favorite, and especially after the HDFC and HDFC Bank merger, we continue to be very bullish on this combination combo HDFC Bank. But the price, because of the short-term selling pressure of FIs, the HDFC stock has been continuously coming down. I think this is the best risk reward for investors. Even I would go to the extent of that this is kind of a FD with equity kind of returns.
Wow, that's a nice way of putting it. Do you see the other pocket which really took it on the chin was IT? Do you have same kind of views on IT, Infosys, TCS, HCL Tech, the derating which happened after the numbers?
No, I continue to be very bullish on the IT sector. What I believe is cloud computing, digitization is a structural shift in the industry. It's not a COVID phenomenon. It's not a 1 quarter, 2 quarter phenomenon. So the demand drivers are very strong. The number of deals, the size of the deals continue to be very strong. Yes, there have been hit on margins, but that was expected because as COVID, has eased, people have started traveling, then some competitive intensity has also increased. But I believe this IT story is next 2, 3, 5 years story. And with the fall, these stocks have become more attractive for us to enter. Infosys, Tech Mahindra, HCL Tech, they are very attractively priced at these levels.
Right. Arun, what are your thoughts on real estate? I believe you're positive on it. How are you playing it? What are the companies you like in that for the really long term?
See, real estate we have seen coming out of a slump after 10 years. Prices are more or less the same where they were 8, 10 years back. The demand, the income levels have risen. After this COVID, everybody has realized that closed door homes are not something where they can work. They need bigger spaces. So there is a very strong underlying demand for housing. And with the catalyst is the low mortgage rates, 6.5, 6.6, at least I have not seen. When I took real estate, my loan for my home, it was close to 7.5, 10 years back. So coupled with this lower mortgage lending rate is acting as a catalyst. RERA has cleaned the market. Lot of business has shifted to the organized players. So the risk that the builder will not complete, the execution will not happen, it will default, has been mitigated to a large extent. So people have more confidence. And right now, the existing inventory in the system is being bought by the buyers. And now a lot of real estate developers are launching new products. So with these new projects, I see next 3-5 years to be good for real estate. We like, I think HDFC Limited, when it was a standalone, was a good proxy. Housing finance companies like CanBank are good proxy to play real estate cycles. In terms of pure real estate play, we like Indiabulls Realestate. Disclaimer, we hold in our portfolios. We like Oberoi. We like Prestige.
So derating which happened in Indiabulls, how did you analyze it? The stock has halved in the last 6 months, from 200 to almost less than 100.
We hold this in our special situation. I would say fundamentally nothing has changed. Rather, we are very near the event, and I am very confident with the new management embassy taking over, we will definitely see good prospects for the company.
Yes, there has been a change in promoter at the corporate level, but that is yet to reflect.
Yes.
Yes. So embassy developments, I think, will be the new name. Let's see how it goes from here on. How are you playing the periphery or the fringe players, like the entire cement pack, which is doing very well in today's session, home improvement, other sectors which are around the real estate? Are you equally bullish there? Anything you've built there?
Yeah, we have not built anything there, but yes, those sectors will also do well. Cement is something which I am little bit, I would say, not that positive for next 2 quarters, primarily because their input costs have risen a lot. The petcoke prices, the freight, and with interest rates rising, we also might see some demand here and there, easing out. So I would say the cement price and the valuations are not that, cheap. We already saw ACC numbers. They were subdued, if you ask me, in terms of volume growth. on a month-to-month and quarter-to-quarter basis. So I think right now, less bullish, less positive on that front for next 6 months.
Adding in the last, say, 8 to 10 weeks of this market turmoil, where have you been building positions? You may have them earlier, but you just started building them because you were, or some new spaces which you have researched.
I think banking continues to be my favorite. I think this is the time to go overboard on banking. I have never seen such. All these banks are coming off an NPA cycle. NPAs will not happen for next 3-4 years. They are just building their credit book now. The wholesale, the retail, and the SMEs, all three will continue to do well. There will be, they have built extra provisions during COVID. So you might also see some write back of the provisions. So all the biggies, we have already seen a transformational change in ICICI Bank. So SDFC, Kotak, ICICI, where we have seen big transformational change. And now with Axis acquiring the Citi portfolio, we will definitely see a lot of cross-selling opportunities. So to me, SBI is already the big daddy of the PSU banking sector. It has done exceedingly well in terms of numbers. If you ask me, any one PSU bank that is closest to the private sector, this is SBI, both in terms of size, both in terms of efficiency, both in terms of the quality of the franchise. So all these banks will take away lion's share of the incremental business.
All right, Arun, we'll let you go on that one. Thanks so much for joining us on